Hello everyone, and welcome to part 5 of GPS Financial Management. We are doing a series on financial management. We started with a workshop that was about using basic income statement and balance sheet and cash flow statements. We also looked at the chart of accounts, the basic chart of accounts. They introduced to the income statement analysis tool and how to calculate more and more KPIs. And this last session is on the most detailed portion of that, which is using our new financial management tool. This webinar, however, has 3 separate purposes. One, of course, is part 5 of the series that we've been working on. Secondly, it also provides training for filling in the Composite financial analysis tool, and I'll let you know why we called it exactly that. And thirdly is an introduction to our new online management group, which we're actually going to be launching March 21st, 2017. And I'll explain later why I chose that particular date. The document that we're going to look at here is the most comprehensive financial composite I've ever seen for a management group. Been developing it over the years. When I first started with management groups, and a detailed composite was way back in the early 90s. And it was okay, it was good in the day, it was very good. And you would fill in your financial data and fax it back in those days. And we would take that data and put it into a composite, which we would then print off as a PDF, and then you would have that as a PDF. The problem was if the data was incorrect, you wouldn't notice it until the actual composite came out, and you'd be frustrated because that's not what I meant. Well, with this particular composite, it allows you to see your responses, your answers, your KPIs instantly as you're typing in your data. And so if something's wrong, it allows you to be able to fix it right away before anybody else sees it, or you send it off to our group, for example, or you provide it to your accountant or whatever purpose you're going to be filling in that information for. So I really like that aspect of it. The other thing about this that's really neat is it allows you to enter your data and then save it and then come back to it later on. So it's not like you have to fill in the entire composite all at once. As you're going through the composite, some of the data may not be available to you. You may have to wait to get something from your accountant. That doesn't matter. Fill in as much as you can and then fill in the rest later on. Now you'll find when you first start, you can't maybe do all of the lines, but do as many as you can, see as many key performance indicators as you can. The data is going to have to come from maybe 3 different sources. Some of it may come from your shop management system, some may come from your income statement from QuickBooks or a program like that, some of it might come from your balance sheet from your accountant, and so you'll get really adept at knowing where to get the information from. And I'm putting together another tool to go along with this to make that even simpler so that you can see each of the KPIs, what the calculation is, what the benchmark is, and then we're creating a document on all the fixes. So how do you get yourself from where you're at to where you need to be? We talked about the GPS. The GPS in your car or your phone actually tells you 3 separate things. It lets you know where you are, and when you're lost, which means you don't know where you are, your GPS shows you exactly where you are, and then you tell the GPS where you want to go to, and then it provides the information on how to get there, the directions. And that's exactly what this is as well, is we allow ourselves to see exactly where we're at. We find out collectively where we should be as far as benchmarks go, and then of course the directions on how to get there. So I want to show you that this comprehensive financial management tool actually does 3 separate things. One is it provides monthly financial analysis, and it allows you to take information, again maybe from 2 or 3 sources, and maybe 4 from your accountant as well. Separate information you may need to ask your accountant, but it allows you to start to analyze your monthly data so you can take the income statement, balance sheet, etc., and be able to see it all in one comprehensive document. So you see the monthly financial analysis. We believe that you should do this every single month. You may not get it done right on the last day of the month or the first day of the second month. In our groups, we give people 10 days after the month ends to send us their financial data, and most people, in fact, is when I was running management groups in the US, the last groups that I was running, we had 100% reporting from 100% of our groups. So we got to that point. So don't be frustrated if you have to be delayed with some parts of this. Do as much as you can. Secondly, it does month-by-month annual trending, and I ran a different kind of group in Canada. It was an automotive group, but it didn't allow you to see the trending. It did the first thing. It showed you how you were doing in that particular month, But what it didn't show you is but the month by month, and we have all the financial data that you're going to see, all of the lines. I believe there's 172 of them, and you're going to be able to see that every single month, all in one sheet right in front of you the entire year by the time you've implemented it to an entire year. And by the way, once you get adept at it, you may decide to go back to the previous year and enter in all of your income statements into this document and be able to see your trending for all of last year. You can go back even years before that if you choose to do that. But I love the month trending. How am I doing in each of these specific areas? Is my KPI getting better? Is it getting worse? Am I getting closer to benchmark, or am I going the opposite direction? 3 is forecasting, and this part of this document is quite complex, and I'm not going to belabor that in this session because in and of itself it is a webinar worthy of just showing how the forecasting works, and I'll show you that when we get to the tabs. And fourthly is a comparison. For those of you that are using this for your management group information, it allows us to see, the last part of this is to allows us to see how we're doing with all of the other members in our group. And again, I mentioned March 21st of 2019. I don't know how I blew that, but 2017. And just quickly why I chose that date, because it's my 55th birthday. And years ago, I worked with Bob O'Connor, and we went to a special meeting in Atlanta on his 55th birthday, and we were launching some new group things. And I thought, in memory of Bob O'Connor, who passed away a few years ago, he was my mentor for sure, and I just thought I would launch this new group with this new format in honor of Bob. So on that day, I'll talk a little bit about Bob and what a neat man he was and all the great things that he taught me. What I'd like to do is to go into the actual spreadsheets themselves. And again, those are the 4 things that the spreadsheet does. One other thing I did want to mention, by the way, is that this particular webinar actually has 3 purposes. 1, it allows you to do part 5 of the series that we've been working on, but also it allows you to see the training on how to fill in the composite. So you may want to provide this to your accountant, bookkeeper, or somebody that helps you with your financial data so they can see how to fill in the composite. And also it is for the purpose of our management groups for providing further training later on for people that will join our management group and be submitting this information to see the last portion of what we're going to talk about, and that is how that compares with everybody else. So I wanted to introduce you to that, and now what I'd like to do is to take a look at the key performance indicators. And this document that you have in front of you is brand spanking new. It is something I've just created literally in the last week, and I wanted to be able to show each of the KPIs all in one document, the definition of those, so what each of them means. Now, new customers for the month is pretty obvious. It doesn't need a definition, but when you get to things like line number 4 there, quick ratios, then a definition for most people is necessary, at least when you first start. How you calculate that, what the benchmarks are, and then the document. I've already done the training on this, of course, but I'm putting it all into one comprehensive package with this document in our management groups, which is going to show how to fix that. So if your quick ratio is not where it needs to be, the definitions here, how to calculate it, the definition, what does it mean, calculation, benchmark, where should you be, and then if you want to know how to fix that, there's too many ways to fix that to put all in one line here on this composite. So it will reference you to what line or what page number in the actual workbook that goes along with this. So this is a comprehensive tool that I've added more and more to, and that's the neat thing about training and being a trainer. You get a chance to learn as you go along and add things and learn things and add things, and so it never is just repeating new things. I love to learn and learn new things. And by the way, TEAM is the group name that we've chosen, and I think most people have heard of this acronym before. It's not something I've come up with, but it's Together Everyone Achieves More, and it's really neat to see people in a management group who are comparing numbers with one another. And I've learned that everybody is king or queen of something. You might have the highest gross profit on labor, whereas somebody else has the highest gross profit on parts, whereas somebody else has the most pre-booked appointments, and then somebody else has the best large labor to parts ratio or labor mix or whatever it is. So the neat thing about a management group is when you see somebody doing much better in an area than you are, they teach you how to fix that, but you're teaching them how to fix things that they're not doing as well at. So just wanted to share that part with you. The KPIs, and I'm not going to get into all the detail, but I want to show you, when I show you the composite, here are the things that you're going to see. The number of new customers, quick ratio, receivables dating, so we can see how much is owed to us over what period of time. So it's kind of nice to see that at a glance, especially when you're looking at trending, and maybe you have had a receivables problem in the past, or you still are dealing with one, and you can see how that you're getting out of that hole quicker and quicker, hopefully. Repair orders per day, we want to see the number of appointments that you've pre-booked, and you're going to see in our composite where a real shop, we're going to look at real numbers from real shops, and we can see that they're getting better and better and better at pre-booking appointments, and of course we provide training on that. Average dollars per repair order, I think, is a very important number to know. The average labor dollars per repair order is a nice number to see. Sold hours per repair order. Line 11, which in this case, it's not a line 11 on the composite, but it is on the sheet I'm putting together with the composite, I believe is the most important calculation of all, the effective labor rate. It also will calculate for you, painfully so, the unbilled labor time, so you can see what percentage of your time that you spent at the shop went unbilled that you did not get paid for. A very important calculation, labor to parts ratio. And then because it divides it in the composite itself, then I divide it for you here to make it simpler. And by the way, one thing I'm adding again to this document is to see which line here matches the exact same line in the composite. So when I started building this, I thought, oh, definition here would be good, calculation would be good, benchmark would be good. I could put the fixes on where they are in the workbook. And then I thought, oh, wouldn't it be neat if I could show you exactly which line on the composite this relates to. So we're coming to that as well. Labor cost of goods sold, we want to see what we paid for our technicians in a matter of dollars. But line 16 here, we also want to see it in a matter of percentage of the labor. You don't manage your business per se by dollars, you manage your business by percentage. We covered that in the first session where we talked about there's no point really, well, I mean, I shouldn't say there's no point, but when you print off an income statement, you should always see the percentage of sales column. And most people don't. I'd safely say that 90% of people that show me their income statement for the very first time, there's no percentage portion on that, whether it came off their own QuickBooks program or their bookkeeping software internally, or it comes from the accountant. And if your accountant or bookkeeper is providing you financial statements, income statements in this case, without percentages, I'm going to encourage you to encourage them to show you the percentage, because it's far more about percentage than it is about dollars. Then we go into gross profit on parts, gross profit on sublet, gross profit on tires, and the gross profit on shop supplies, and you will see that in dollars and percentage. Then the overall gross profit. We like to see line 23, warranty work in dollars. We want to be able to see how much warranty work we did that particular month. And in this case, we're talking about the cost of the technician's time to redo that work. Basically, it's a comeback. Total revenue from parts, sublet, tires, shop supplies, and environmental fees. We see that line, of course, and the total cost of goods sold in dollars. Then we get into the expense categories, rent as a percentage of sales. And again, I'm going to be listing all of the benchmarks that we have ones for. We have a benchmark for rent, which is 5% of sales, just for the record. Not every single one of these lines has a benchmark. If we did that, that would be complete micromanagement, and that's not what we're teaching here. I do like the way it's broken down on the composite. As you'll see, facility expenses in dollars, and you're going to see the percentage in sales, what percentage of your sales went to just your facility. We'll see vehicle expenses. That would be vehicles that are owned by the shop, and it expressed in dollars and expressed, now it says dollars there. That's actually an error. Again, we're creating this document, and I'm just going to change that right now to percentage and be clear to save it. So it's there next time. Number 34 is credit processing fee in dollars, and there's times where you need to shop that and see better ways of doing that. And when you're in a group, it's kind of nice to be able to see how much other people are paying as a percentage of their dollars, and then you would have an idea that maybe you could use a different service or shop better, or negotiate better with whoever's doing your credit card processing. And we see that, of course, in dollars, and we see that in as a percentage as well. We see all of the financial expenses in dollars, the financial expenses as a percentage of sales. And then we see the owner's salary as a percentage of overall sales, which is something we definitely have a benchmark for. We also have a benchmark for your service advisors, percentage of salary, total administrative costs, total costs or administration as a percentage of overall sales. So you get to see exactly how much money went from sales down to pay for your total administrative costs and the percentage of that as well. And of course, we have a benchmark for percentage. We couldn't possibly have a benchmark in dollars because every shop is unique and different, and it changes from month to month from a sales perspective. And then I love the breakdown we have in marketing and advertising, and we want to see the advertising costs and marketing costs to bring in new customers. Well, we also like to see the marketing costs for database marketing to get people back more often. And marketing and advertising is a total cost of sales and percentage. We have a benchmark there. We'll cover that later. And one of my favorite things about this particular document is the profit year to date. So you can look down at your information and see exactly what the profit is year to date. And it's an absolutely wonderful thing to be able to see. And so here what we're looking at is the actual composite itself. And I do want to make it clear, and I'm keeping this information open on the side here so that we can see exactly where the forecasting is, where the actual is, and then at any time you can click to a specific month. Now, to be very cautious with this from a training perspective, please make sure that when you're entering data, you click on the month first and start adding it there. Now, you're going to put the month name up here, of course, but some people will send a composite to me, for example, and I'll open up January and it's blank because they actually put it into another month, or they put it into forecasting. And you want to make sure that you don't use forecasting at all until you are, well, I guess, well trained on how to do the forecasting. And I'll just mention forecasting here. And again, we are doing a separate webinar just on how to do the forecasting. You can see this particular shop. It's a real shop's numbers as far as it goes for actual data, January, etc. But forecasting is quite different in that it allows you to see where you're at compared to where you thought you would be or where you wanted to be. So it's your own personal goals. It's not forecasting how you're doing compared to the benchmark. Your actual data here shows you that. But when it comes to forecasting, you're going to be able to see where you're at compared to where you said you would be at. For example, January VAR is January variance. And of course, it's the beginning of the month, so it's going to be identical. January actual is going to be the same as the variance. And there's really no forecasting. I can see the shop started to do it, but it's a lot more complex than it looks. You don't just, for example, take something that you pay for a year and divide it out through the month. Now, some things are consistent. Your rent may be the same every single month throughout the year, so you can put it into your forecast for that particular month what the rent should be. But when it comes to sales, if you're in an area such as Ontario, Canada, or any place that's cold, where there's a tire season, November goes crazy and your sales just go up. Of course, gross profit usually comes down and other things go down like average invoice. But you want to be able to know that your sales in November are not going to be what they are in February if you're in a tire area where February can slow down. Now, February doesn't have to slow down. It doesn't have to slow down to the key or the way that it usually does. And we show in our training, of course, how to prevent that with pre-booking appointments and filling up February and other typically slow months in advance. But if you were to take your sales for the entire year right now and divide it by thinking that those sales are going to be the same every single month, well, it's not going to be that way. And so just so you know, from a forecasting perspective, we encourage you to take your income statement for the entire year of last year, divide your sales each month, divided by the entire sales for the entire year, and use that number for each month that you're forecasting. And we do that with expenses as well. And again, this gets really complicated. Just to let you know, I'm going to suggest that you don't start with the forecasting part at all. Now, if you're extremely well-versed in Excel spreadsheets and also in background in accounting and bookkeeping, you may want to be able to start to tackle this on your own. For most people, it takes a while to get into how the composite works first before we get into the forecasting itself. So please always make sure that you're entering your actual data for that particular month. And if any month you want to look at, you can see how you're doing in June of this case of whatever year, actually what did you do, and it pulls that from your actual numbers for the month. And then forecasting, it shows you what you said you would do, what your variance is, what you said you would do in June compared to what you said you would do in June, and where you actually are in June. But it does the year-to-date variance as well. So it's accumulating each month. So it's not just allowing you to see in June where you thought you'd be in June compared to where you are, but you can see year to date. So as the year progresses, and on the bottom of this you can see that it of course goes throughout the entire year, and so you're able to see all of your data. So I just wanted to show you the forecasting part. Again, we provide separate training on that. The actual data, this is where you're going to spend most of your time looking at your composite. And I just want to go through each of these lines individually. I'm not going to pull up all of the data that goes along with that, but anytime you go into this little red curly Q or little whatever you want to call it, it's a triangle, it's going to show you once you click your mouse on that. And I know some of you are well versed in spreadsheets and you know this, but we have to assume that there's people looking at this that have never worked with Excel before. So you want to be able to just click in here and it's going to tell you exactly what goes into that line. So anything that you see here like as a cream color, you might see as a slightly different color, but this color in here is where you're entering your data, and where you see the green is where it starts to do the calculations for you. So as you're entering in the data, then it allows you to be able to see what the answers are going to be down here. So if something here looks obscure, then maybe there was an error here. And as I mentioned way back in the day, when people filled their other types of information in, would send this in by fax, we'd put it in, assuming that they were right, and a month later you realize you made a mistake a month before. Well, this composite, that's not going to happen, because for example, if you do something wrong here and it tells you that you're working on 935 cars a day, then you go, oh, where did I make my mistake? Oh, I made a mistake up here. And so here's what we do. Number of customers for the month, so you're going to simply fill in how many customers you have for that particular month. And I think I'm just going to go to this month here. So you're going to fill in, I don't want to look at the trending right now. Again, the forecasting we're going to cover in a separate webinar for those of you that are in management groups. It's not part of the Series 5. It's, again, a whole different workshop in and of itself. The actually, you know what, I'm going to go back to actual so we can see the little red things. The quick ratio, this comes from your balance sheet, and in that last sheet that I showed you, it shows you where to get the information, whether it's from your sales, your income statement, your expenses, your cash flow analysis, or your balance sheet. The ratios, I'm not going to get into all the definitions here, but you're going to be able to simply put in what your quick ratio is. We show you how to calculate that, and it comes from your balance sheet. We're looking at a real shop, and these are really, really good numbers for this particular shop. He's been at it a long time, and to see 9.6, what that simply means, if he took the cash in his bank account and his accounts receivable and went to pay the bills that were due, current bills, he would have $9.60 to pay every bill that he has. So it's actually probably not a good use of cash. He may have too much cash in his bank account. Some of you listening to this wish you had more cash in your bank account. By the way, just so you know, some people we see are at 0.6 instead of $9.60, which means that they have 60 cents to pay every dollar that they owe, so they become in a cash flow problem. And of course, we provided training on cash flow. Receivables, this is really simple. You're taking that from your data. This shop obviously doesn't have any receivables. Days open, pretty straightforward. How many days you're open, how many technicians on staff. That does not need to be a whole number. So if you're the owner of a shop and you spend half your day in the bay, please put in 4.50. If you spend 75% of your day in the bay, 4.75. If you're 25, 4.25, because you want to make sure that these numbers are right. So if you don't put yourself in here and you do spend time on the bays, or in the bays I should say, you're seeing the sales from your own labor, but you're not seeing the cost against it, then your gross profit's going to look like it's much higher than it really is, and it's not accurate information. Total hours paid to your technicians, and again, that would include yourself. Total number of repair orders you wrote for that month, 187 in this case. Number of appointments pre-booked, and we really want to be able to take a look at more and more and more pre-booking. This group, by the way, this was in the first year, I believe, of this group, maybe a little bit into the second year for this group. And this shop got a lot better at it, but I'll cover that when we get into the training. Repair orders per day, it's calculating that for us based on the information we put here. Repair orders per day is kind of a nice number to see if you're to what we consider activity-based. Was it a slower month, but you had higher average invoice? And of course, the idea is to do as much work per vehicle as we can. Most cars, or shops I should say, don't have a car count problem. They have a problem making every car count. It calculates for us average dollars per repair order. Now, I'm not just pulling up one that a shop is doing really well. This shop does really well. I would like to say up front that this shop is in the United States. It is in California, so the labor rate's a little bit higher. Actually, the posted rate at that time was only 89. But this particular shop works on import vehicles. So they work on Jaguar and Ferrari and Audi and BMW, etc. Lots of BMW at this particular shop. So don't be discouraged that your invoice is not anywhere close to that. This shop is premier when it comes to that. But like I said, everybody's king or queen of something, and you're going to see some of the areas where he falls behind because we can't be kings and queens of absolutely everything. Labor dollars per repair order, I do like to see that. How much are we seeing in labor dollars? On the onset here, it's kind of nice to see that is average dollars, and the labor dollars 255. Now it's not quite half of that, but there's going to be some, maybe some tires. If he sells tires, we'll see that down a little further. But when we say average dollars, we're talking labor parts, sublet tires, towing, shop supplies, and environmental fees. It calculates for us the sold hours per repair order. The shop is doing really well with sold hours per repair order, 2.87. Our benchmark is 3. Now, it's because he's worked at it for quite some time, and I recall at this shop he was much lower than that to begin with. And just so you know, the average independent repair shop is only 1.1 to 1.2 hours per repair order. So if you're sitting at 1.1 to 1.2, then you can know that you're pretty much an average shop. If you're sitting at 1.5, by the way, just so you know, the difference between 1.1 and 1.5 is a huge amount of dollars in most shops. That 1 point or 0.5 of a work order higher is absolutely huge dollars when you look at the hopefully good car count to go along with that. You fill in your posted labor rate here. The effective labor rate is a very important calculation, and basically what it's showing is that this shop says they collect $89 an hour. That's what their labor rate is internally, but they're actually collecting $80.88. Now, because I believe that the percentage is even more important, we see the effective late percentage is 90%. And that's not bad. Just so you know, the average independent repair shop, and don't be surprised when you do this calculation that it shows close to 65 to 67%, because I notice when people join management groups that they're much closer to, well, the average is 67%, just so you know. Our goal, just so you know, is to be 125% of that number. So we'll cover that more when we talk about benchmarks in our training, but the effective labor rate percentage is not bad for this shop. He's collecting $80.88 an hour out of the 89 that he says. What causes that? Well, if you do lots of oil changes, you're not collecting $89 an hour. It's going to be much less. If you do a lot of tire repair, it's most likely going to be lower. If you do a lot of maintenance, it's going to be a lot higher. So there's a lot of things that will increase or decrease effective labor rate. And as I mentioned, when we go back to the other form that I looked at, when we were back here, just to be clear, all you need to do is, you'll notice I stopped talking when I'm switching through because you won't be able to hear me because it takes up so much bandwidth. But effective labor rate percentage, then again, the definition, what does it mean? What it means is how much did you actually collect per hour, not how much you said you checked or collected per hour. How the calculation is done, the benchmark, we just said 125%, but then you're going to be able to see all the fixes that go along with this. And this column here, just so you know, comes from many of the training programs. And again, for the record, I want to be clear, all of these fixes, the document that I'm talking about here is for the management group. So I want to be clear about that. We're building this specifically for the management groups, but I did want to show you on this document here, which you are getting, what each of the analyses are, the KPIs, and you will be getting the definitions, the calculation, the benchmark. It's just the other that we go through in our management groups, and that's a lot of training for each of those lines, just so you know. The unbilled labor time relates to that exact same number. There's actually 3 different ways of looking at effective labor rate. I don't want to get into all of that right now, but there's 2 ways really of looking at it right here. One is that the shop actually collected $80.88 per hour of the 89, or they only sold 80% of their time. So that would mean that 9.13% of the dollars, effective labor rate per hour, or effective how much you sold of your actual of your labor time. So this shop sold 90% of its labor, which is not bad. They only lost 9% of the hours. So again, there's 2 different ways of looking at that. The fixes are the same. Basically, a lot of this is gravy work versus grunt work, too much downtime. And by the way, I would like to explain why I believe that effective labor rate is the most important calculation of them all. And by the way, just recently I was speaking with a client who was in one of my management groups many years ago, and that's gone on to somebody else. And she said, one of the things that I miss was in your training, she said, and I don't exaggerate stuff, she said, you always focused on effective labor rate, effective labor rate, effective labor rate, and you always said it was the most important. Unfortunately, and I'm not putting down this other facilitator, but she said he just doesn't refer to the effective labor rate. And she said, quote, when I focused on effective labor rate, she said, that is when we started making money, when we realized that we were selling hours, but the effective labor rate for those hours was too low, and we learned how to get the effective labor rate up. And by the way, you can get a higher effective labor rate than you say you charge because of efficiency. And why I like it, I'll make this clear, effective labor rate relates to almost everything that you do. It relates to your productivity, it relates to your efficiency, it relates to your selling skills, it relates to your upselling skills. It relates to how much you educate your customers about diagnostics and charging correctly for diagnostics. It relates to being a fix-it-as-a-break shop with a lower effective labor rate, or selling a lot more maintenance that relates to a much higher effective labor rate. And in our selling class for service advisors, I love this subject, and I say, what are the things that bring down your labor rate effectively? In other words, what causes you to charge less per hour or collect less per hour than you say you charge per hour? Oil change is the best indication of that. But how do you fix that? There's some things we can't stop, and we're not going to stop doing oil changes, but we need to offset that with other types of work. So there's 2 ways of looking at that, but the fixes are the same. How do we get paid for all of the time that we're there? Our goal for you as trainers, Kevin King and myself, our goals is that you get paid for everything you do at the right amount of money. And you may be selling the hours, but the effective labor rate is not there because you're not actually efficient enough for whatever the things I just mentioned are. So it's about selling all the time, yes, but selling the time at the correct labor rate. This calculation is extremely important, and that is the labor to parts ratio. And that's telling us what percentage of the money came in the door from labor compared to parts. And this shop is doing $1.09, which is pretty decent. They are collecting $1.09 in labor for every dollar in parts. And I can tell you, when I launched management groups, and the number is really simple to remember, 100% of the people that joined our management group saw more money from parts than they did from labor, 100%. And that shouldn't be the case. And if you've taken training with me before, you know that I say it this way, is how often do you sell parts over your counter without any labor? People come in and buy belts and water pumps and hoses and starters, etc. Hardly ever does that happen. Maybe once in a while you got somebody a part that they couldn't get on their own, but hardly ever do you do that. Some people never do it, some people once in a while. How often do you sell labor without parts? Well, that's something that should happen daily, maybe not every single day, but at least on a weekly basis. A person comes in, for example, and they're looking at buying a vehicle. They ask you to inspect it, you inspect it, and they decide not to buy it because of the results of the inspection. Well, they didn't buy any parts because they decided to just pay you for the inspection and be happily down the road thinking, I'm glad I didn't buy that vehicle. That was money well spent because I didn't buy a lemon. And by the way, I love the line that not all lemons are yellow. There's a lot of lemon cars out there. And So we inspect it, but we didn't sell any parts. A person comes to us and they want something diagnosed and they choose to not get it fixed, or they don't have the money, or their brother-in-law is going to fix it, or whatever. So sometimes we sell diagnostics that doesn't turn into a sale of parts to go along with that. Sometimes we're doing a brake inspection, and during that period of time, that half hour, we're not selling parts during that time. We're just selling the labor. Now, in most cases, we are going to go ahead and do the repair of the brakes, but that's a separate labor operation, and parts to go along with that labor operation. So it's a separate time. So during the inspection itself, we're getting paid for it, but we're not getting paid for parts. And I think it would be kind of neat, I thought of this recently, to be able to take a look at your parts purchases in the morning and your parts purchases in the afternoon as it relates to ordering parts. There's no question we're going to order more parts in the last part of the morning and the early part of the afternoon, because we start the day usually with inspections and diagnosis first. Now, if you sell a lot of maintenance, that isn't as much of a difference, because you're starting the day hopefully with maintenance as well. But in most shops, the first couple hours of the day is diagnosis and inspection, and so you're doing labor without parts. Years ago, most of the shops that came into most of the vehicles that came into our shops when I was writing service back in 1978, 79, and 80, there wasn't a lot of diagnostic time. Some stuff was really easy to diagnose. Some of it you could actually diagnose by sound. And for those of you that remember the day, you know what I'm talking about. And we spent most of our day installing parts. Well, today it's a lot tougher, and we spend a lot of time just finding out what the problem is. I did some research with a group actually in Seattle quite a number of years ago, and we wanted to find out what percentages of vehicles came into our door that needed to be diagnosed or inspected before we did any work. Now, I've asked that question in groups, or training sessions, I should say, and people say, well, all of them. Well, that's not really accurate. If I come to your shop for an oil change, and I need an oil change, and my oil change sticker says it's time, and you did the oil change, and now I'm at my 3,000 miles or 5,000 kilometers or whatever, you don't need to inspect the vehicle to know that it needs an oil change. You need to do an oil change. Now, you're going to do an inspection along with the oil change, but that's a separate step again. And so sometimes we're going to be doing the inspection without the parts on that. And so our labor sales definitely should exceed our part sales. And by the way, that group was 83%. About 83% of the vehicles that came into the shop needed to be inspected or diagnosed before we could work on them. The second factor here is that labor is more profitable, or should be more profitable. Labor gross profit, you'll see here, if you haven't seen it before, should be 70 to 75%. Well, there's no way in the world you're going to get 70 to 75% on parts. I mean, once in a while maybe, but you're certainly not going to sell parts at 75% overall. Our benchmark is 50. So labor has a higher gross profit, and we sell more of it. Parts has a lower gross profit, and we sell less of them, because labor drives our business. Labor sells parts, sublet, tires, towing, shop supplies, and environmental fees. So why is it that most shops, and I don't mean all the ones that I've seen with numbers joining the groups, yes, most shops, without a doubt, see more money from parts and labor. I'll give you one example of that. I had a fellow who was in a session in Ontario, Canada. I got to know him really well and joined a management group that I was running at the time years ago. And he said, you know, I love the stuff you teach, and I've made lots of changes, but he said, I don't think the labor to parts ratio thing is accurate. He said, I'm a third generation shop. And he said, I've looked back at financial statements, and my dad never had labor sales exceed part sales, and his dad never, ever saw labor sales exceed part sales. So he thought I should think through that calculation. I recall that being in June of whatever year it was. In September, Jim is his name, he sent me an email, and he said, you're not going to believe this. He said, but in August, our labor sales exceeded our part sales. And when I saw him in September, because we did meet over the summer, he mentioned that again. And then in October, because I was seeing his numbers, and I can assure you that every single month, to the best of my knowledge, I mean, I'm not 100% sure, but all the times in the group, the labor sales definitely exceeded the part sales. And I'm going to safely say that every single month since, his labor sales have exceeded his part sales monthly. Now, not daily. If you track this daily, it would drive you crazy. You sold the transmission today. Of course, your part sales are going to exceed the labor sales. But because we do a lot of labor at a higher gross profit than parts, and we do more labor than we do parts, we sell labor without parts. Hardly ever do we sell parts without labor. At the end of the month, the end of the quarter, the end of the year, the bulk of the money that you see should come from the sale of labor. Just so you know, this equipment specialty tools purchase doesn't relate to any of the calculations. And the reason I added it there is because if you're in a management group, for example, and you're going through all of that above data, it could become a little bit painful because you think, ouch, 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 especially when you see your effective labor rate or your sold hours per report or whatever it is, and you think, oh my God, that's painful. And you're in a group, then you get to brag a little bit and say, but you know what, I just bought this brand new scanner, or I bought this new tool, and you want to talk about it. Really, that was simply to get away from some of the pain that may have just happened above. And in a management group, I found that a little bit helpful, more of a breather to you after you get to talk about your nice new shiny piece of equipment after you just got kind of sort of beat up from the numbers that are above. So those calculations are done in the composite, and again, all you need to do is click above the red little thing here, and it's going to show you what data to put in there. The next section of this is pretty straightforward. All you need to do is to fill in your labor sales for that month, the part sales, which of course are separate. Shop supplies, we believe that we should be charging shop supplies separately. And for those of you that have taken our training, and some places in the US and in Canada, you're not allowed to charge a percentage of shop supplies. And so we do have shop supply kits. And if you've never seen that, you can just send me an email, kelly@kellythecoach.com, kelly@kellythecoach.com, and I can send you off the parts kits, and it's a great way. And basically what it is you're quantifying it. So you're telling people exactly what they're getting for the amount of money. So instead of showing shop supplies 8% or shop supplies in dollars, it actually explains what those shop supplies are. And we have ones for brakes, we have ones for welding kits and engine kits, etc. And basically it allows you to quantify. A couple things we learned when we did that: it allowed you to collect more money because it's usually more profitable charging per item in the kit rather than a percentage, but it's less questions from the customer. So a person doesn't just look and say shop supplies, $18.72, what does that include? And it actually lists it for them there exactly what that includes. Sublet, obviously the shop is doing a lot of sublets. Though that's a lot of money to do in sublet in one particular month. For some reason it was big that month. We look at some of the other months, and again, I don't want to get into the trending right now, but because I want to cover that separately. But he did a lot of sublet that month. Tires, he didn't sell tires, either that or they were in his parts. I don't remember, but you definitely want tires separated from parts. I'm not saying that a tire is not a part. I mean, it's technically a part of the car, but the gross profit benchmark is different. Our gross profit benchmark on parts, and we're going to cover gross profit shortly here on the composite. The parts gross profit 50%. You're certainly not going to sell tires at 50% gross profit, and so because that number is so different, that's why we separate it. Towing, if you do your own towing or you've done it sublet, you can do it that way as well. How much you collected in towing. Environmental fees, he didn't charge those. You don't have to. You may want to build that into your shop supplies. Some shops I actually see shop supplies / environmental fees. In this particular case, he didn't charge shop supplies. Other, just so you know, other is there for the purpose of seeing anything else that you sell so that it can match your income statement. So this could be, if you sell gas, then you could put your gas sales there. If you rent out a portion of your bay, let's say to a detail company, then that could be there. If you happen to sell parts over the counter, you may want to separate parts over the counter. So this allows you, and by the way, I wanted 2 categories here. So lines 29 and 31 are miscellaneous category and other. Because some people, not often, but some people in a group said, well, I want 2 lines. I want one for the cars that I sell, or I want one for renting out a portion of the bay, or I want one for parts of the counter. So just so you know, we wanted this comprehensive enough that you didn't have to be limited to one of the miscellaneous categories, and we separated it to keep it separate so that it's pretty obvious. And by the way, you can simply right-click in there if you want for your own composite, and you say, well, that's going to be parts over the counter, so you can just, and I'm trying to reach past my microphone to type in over counter, and you can simply change it to be that. And so now you're going to see what your parts over the counter sales are. Sales discounts, and that needs to be a negative number. I'm not sure why in January he was showing it as a positive number. Maybe he just forgot to put the negative in front. But this is anytime you do any form of sales discount. If you decide to run a $20 off, for example, oil change promotion, in the sales broken down, and oil changes need to be broken down. How much did you charge, but what percentage of that, or what dollars was labor, what dollars was parts. Some people put all oil changes under one or the other, which throws off your sales and your cost of goods sold and your gross profit on both of those. But if you decide to take $20 off, or a $20 coupon, or a $25 coupon, you want to track that. So you want to see what you did. You want to see what you did generate in sales. And then you want to see how much you gave back to your customers in the form of discounts. It might be a seniors discount. It might be another form of discount that you provide. You want to make sure that you see that. And miscellaneous, again, the shop isn't putting anything there. So we see the total revenue for the shop in a month is a little over $100,000. And again, this was January. Now, the cost of goods sold, we believe that labor is a cost of goods sold. You sold labor, you paid for the labor, and you want to make sure that you see how much you paid. And if you click this on here, you're going to see that it's the technicians and apprentices, their wages go here. To be clear, this does not include what we would consider a payroll benefit or a burden. The difference here is a payroll benefit is something you don't have to provide by law. A benefit is you have absolutely no choice. You can't opt out of workers' compensation. You can't opt out in Canada out of EI, employment insurance, or used to be unemployment insurance. Now we call it employment insurance, EI, CPP, Canada Pension Plan, or workers' compensation in the U.S., SUTA and FUTA. You can't just opt out of those. You don't send a letter to the IRS or Revenue Canada and say, hey, please take me off your mailing list. I've decided I don't want to participate any longer. You have to provide those, and so those are a burden. So anything that's a burden or a benefit, you provide pharmaceutical, or you provide dental, or you provide vacation time, or whatever, that does not go here. The only thing that you put in this line is the wages of your technicians and any apprentices or tire people and yourself. So if you spend half your day in the bays, you need to be able to determine a wage for yourself. Even if you don't pay it per se separately, maybe it's coming out of your salary or your whatever dividends, you want to make sure that you put in here, if you put in $25 an hour and you worked 4 days a week on average, then you need to make sure that you put it in here. It doesn't have to match your payroll, but for the purpose of looking at the big picture for your business, if you put nothing in here for yourself, and then we come up, but the labor that you generated showed up here, your gross profit is going to be completely inaccurate. So you need to determine, and you don't have to painstakingly do it, but you want to have a good indication month after month, each month, how much it's going to automatically calculate the labor portion of that in revenue because you collected the money. But you need to make sure that you put it into your wages. So just determine whatever your wage would be, $25, $30 an hour, $35 an hour. People ask me, how do you decide that? Well, my question would be is if you hired somebody with your skill and ability, your background, your experience, the amount of tools that you have, what would you pay that person? What do you pay that person? Or if you went to work for somebody else and somebody said, well, what are you looking for a wage as a technician, whatever the hourly amount is? Or salary, it might be a salaried person, maybe a foreman, you divide that, put the wage in there, I should say, just the wage, the salary for the month, I should say. So it doesn't have to come down to an hourly amount. But what would you expect to get paid as a salary working for a technician someplace else, or an hourly amount? Calculate that at how many hours you work. On average, you can change it from month to month a little bit if you want, but don't spend a lot of time. This is not about micromanagement. But big picture, you want to see, yes, how much sales were generated from the work that you did, but what would you have paid somebody else if they had to do that work for you? You may not use line 37, which is casual and contract labor, but if you do, then you're going to fill that in there. Then you see the total labor expense, which is actually cost of goods sold, and then you see the margin on the labor, in this case $66.83. Now, having said that, I can tell you that most shops, not all, but most shops actually have their technicians as an expense. They're not seeing it as a cost of goods sold. And yes, I've had a couple of arguments, more than a couple, with bookkeepers and accountants, I should say, who say cost of goods sold. Time is not a cost of good. It's not a good. It's still something that you bought and sold. In reality, you want to see everything that you sold. You want to see what you paid for what you sold so you can see your gross profit on that. Every single day you buy parts, you mark them up for desired gross profit, and you sell them, hopefully using the matrix, and we covered that in this series, the regular matrix and the algorithmic matrix, and hopefully you've seen a substantial increase in your parts gross profit since then. But in this particular case, every single day you buy labor. You buy labor from your technicians, whether you buy it from yourself, because you spend time in the bay, or you're paying for your technicians. Labor is really simple. You give them money, they give you time. If they stop coming to work, you stop paying them. And if you stop paying them, they'd stop coming to work. Of course, if you work for yourself and don't pay yourself, you still come to work. But that's another workshop for another time. But every single day you buy time, you mark it up, which becomes the labor rate. Every day you buy parts, you mark it up, which becomes the sale of the part and the desired gross profit. You need to do the same thing with labor. And labor, as I mentioned, should be the number one thing that you sell. You should see more money from labor than anything else that you sell. So we want to be able to track it. What's the gross profit on the labor? So if your bookkeeping shows your technician's wages as an expense item down below, all you need to do for the purpose of this composite, initially at least, is to take that amount out. Again, do not include any payroll benefits or burdens. You're simply going to have the direct wages there. And you want to be able to see what your gross profit is on that labor. And again, every day you buy labor, you mark it up, it becomes a labor rate. You want to find out what you collected in labor. We see that in sales. We want to see what we paid for the labor. So if in your income statement, it's down below, just pull it up for the purpose of this. The bottom line doesn't change here, but the gross profit benchmark is important, especially when you're comparing one shop to another. Somebody might be at 78%, somebody's at 62. You say, how come? Well, my expenses for my technicians, my wages are down below. And for the purpose of comparison, I love it up here. I think it's the easiest to understand. Our benchmark is gross profit on labor, and I see that this particular person changed that. I want to make this clear that the benchmark for overall gross profit is 60, but the gross profit for labor, gross profit, I should say, is 75%. So he's not doing too badly. He's getting 66% gross profit, which means for every dollar that comes in the door, he's able to keep 66.83 cents of that dollar for himself after he's paid his technicians at least their wage before the payroll benefits and burdens. The next is parts, and the reason we put labor first is because labor should be higher than parts, so we like to see that number first. We can see what the part sales were. We've put that in. If you have to pay for freight and delivery, depending on where your shop is and what you're ordering, if that's the case, you can put that in there as well. And we believe you should charge your customer for that, unless it was our mistake. But if somebody's in a hurry and we have to have something shipped, we can charge the customer for that delivery. You can put that under your parts and then see the overall margin on parts, including freight and delivery that you charge for and that you paid for. So this person's gross profit on, and by the way, I did this arbitrarily. I just chose one shop when I was doing this. I have composites for every member that was in all of the groups. I just happened to choose one, and I actually use a different one almost every time I show this because I don't want to get into the habit of memorizing the numbers, and I certainly don't want to choose the best or the worst shop either. Anyway, the shop's doing pretty good. This fellow is left with 48% gross profit, a little more than 48. The benchmark is 50, so the shop's doing pretty decent, and I know the shop is using a parts matrix. Sublet, again, I don't know why in this particular month, and maybe there's the way it worked out from month to month. It's only showing as gross profit sublet was 3.69. And just for the record, some months you're going to see it negative, like we go over here, we see it at $202 or 202 negative. And that's the way sublet may work, depending on how you're paying for it. You may pay for the sublet and then get the money from your customer later on, or the customer may be paying you on that invoice, and then a week later, which is into the next month, you're paying for that. So it's really important when it comes to something like this, where the numbers are going up and down a lot. In sublet, it happens a lot. depending on how you enter it into your books. Did you enter it when you paid for it or when you got the invoice? Did you enter it when the customer paid you, and etc.? So just so you know, what becomes important there is the annual information at the end, what the average was for the entire year. And the benchmark there for sublet, we said, was 30%. This shop, for whatever reason, doesn't sell tires. I disagree with that. I think a shop should sell tires. Maybe he just didn't want to for whatever reason, but your tires are separated. And the margin on tires was 0 because he didn't sell any. And by the way, that defaulted to $1. Instead of putting 0 in there, we defaulted everything to $1 in your blank composite. When you get this, it's blank. The benchmark is 30%. Shop supplies, that's an optional thing because it's a little bit more work. I mean, every time you buy parts from a part vendor and there's some shop supplies that are included in that, brake cleaner or whatever, you may want to separate that out, and you can do it with your chart of account number. So the RO number becomes the PO number when you order the part for the vehicle, but the line item on your chart of accounts, let's say shop supplies is account 8,000, so then when you order it, it's 8,000, so the PO number becomes 8,000, so you know that everything in the 8,000 category from all of those part vendors was actually a shop supply, not a part. And I like to see it separated out. It takes a little bit of work to be able to separate it out the way we just talked about. Maybe you're not doing it that way, and that's okay. Still fill this in and leave that as 0. It's simply going to show 100% gross profit on shop supplies. I'd say that probably half the people that have been in a group for even up to a year, for example, will still show 100%. And I don't see that as a big issue. We're not talking about a lot of money anyway, but he is tracking it. So he spent $284.35 that particular month on shop supplies. So his gross profit on the the shop supplies was 85. If you do track it, our benchmark is 80. Warranty work, in this particular case, obviously the shop didn't have any warranty work, but if you have warranty work for that particular month, you'll add it. Again, we're looking at towing, whether it's done internally or externally. We can see what his towing cost was. Other direct expenses, as I mentioned above, you have a miscellaneous category and another category. You can have 2 separate categories. This is where I mentioned about parts over the counter, so you can see what you paid for those parts that you sold over the counter. If it was rent, of course, there's no associated costs unless you're paying for the gas, electricity, and charging them, etc. He had one under direct expense, what he paid for it, miscellaneous, he's not using anything. That's fine. He's charging environmental fees. And so the total part, sublet, tires, extras, was $30,501. So his total cost of goods sold for everything that he bought, including his technician's time, so his labor, parts, sublet, tires, towing, shop supplies, and environmental fees, he spent $46,329 of all the money that came in the door went to the sale, to what he sold, I should say, which leaves us with the gross profit, the gross margin or the gross profit after he paid the $43,329.87 for labor, parts, sublet, tires, towing, shop supplies, and environmental fees. From his sales, he was left with $54,645 and 54.12%. So he's at 50%, 55%, I should say, gross profit. The benchmark is right there, 60%. He's actually doing pretty good on overall gross profit. One of my favorite things about this particular composite is it breaks it down by expense categories. Now, in most cases, your income statement is going to break down things alphabetically, which there's no alphabetical benchmark. We don't say, well, your A category should give you 52%. I love this because it breaks it down into categories that are important to see a benchmark for. Now, we do not have a benchmark in every one of these lines. Again, that would be micromanagement. That's not what we're talking about. And you don't have to put every single line in. You can combine some together. If this doesn't mirror image your chart of accounts, that's fine. Don't get so hung up on that. What we really want to see mainly is the sales cost of goods sold and the KPIs that we looked at on top. But if you are tracking your shop supplies or your shop maintenance and equipment repairs, some months you can see he had some, and this month he had none. Equipment lease, that could be any type of equipment that you're leasing, of course. Small tools, he didn't spend any that particular month, but other months he did. And by the way, these little percentages in here are there in case you want to see that. Software and all data expense, $180. I don't want to spend time on his numbers as much as I want to spend time on the categories. Uniforms and laundry separated out. Waste removal. Maintenance on his own facility. If he owns it, then it's going to be a higher amount unless the landlord's taking care of it, depending on how you're set up with your landlord. Rent, just for the record, is one area that we do have a benchmark, and that's 5% of sales. We can see that this shop's facility is either a little bit bigger than he should be in, or his sales aren't as high as they could be. He's at 7.27%, and this is just direct rent. The utilities and everything else you see below that, so make sure you separate those out. So his rent's a little bit higher than it should be, depending on the sales for that month. Property taxes, this is something that you're probably going to pay once a year. In that case, you are going to divide it by 12 for the purpose of this, because you paid 12 payments of that in a month. And when it comes to the variance and the forecasting, that's exactly the way you do it as well. Utilities, you could put gas and electricity together, whatever you want to do. Security, looks like he pays his security bill a few times a year. Insurance, and that would be facility. Anytime you're wondering what number is here, all you need to do is look up at facility expense, so you can see that that relates to facility expense. Because sometimes there's something here and you think, oh, what insurance is it talking about? Well, look at the major heading, in this case line 66, and it's facility expense. So then we see the total facility expenses for this shop was $10,115.81 for that month, or 10%. Now, we don't have an overall benchmark here. If I did it, probably be around 10 to 12%. So he's doing pretty good there. Again, the one major benchmark here is 5% of your sales should go to rent. The next category, and I really like it, it breaks it down again by category. So the next category is vehicle expense, and we can see vehicles that are owned by the shop. How much do we spend in fuel for those vehicles? Did we provide rental vehicles for customers? Maybe once in a while we messed up and thought, hey, let's put them in a loaner. And that's obvious that it happened in that month that he had to rent a vehicle for a customer for whatever reason. Insurance, and again, what insurance are we talking about? Vehicle insurance. So earlier we saw insurance that was under facility. We're talking about vehicles that the shop owns, and maybe he doesn't actually own any separate vehicles, I don't know. Lease, if you lease vehicles, and repair and maintenance on your own vehicles, of course, it was done in your own shop. Then we get down to this line. He only paid $75.75 for total vehicle expense for a shop in the month. Most shops are going to be a little bit higher than that. The next category is financial expenses, and again, I love these breakdowns. The categories are awesome. It's the best breakdown I've ever seen, because again, alphabetically is meaningless really when it comes down to this, but we can see exactly what percentage of the dollars that came in the door that went to facility, to vehicles, and now we're looking at financial expenses. Amortization and depreciation, that's usually done once a year, but he divided it out by 12. And again, that's exactly the way you do it with your variance as well, but you do it with every line, not just the ones that you pay once a year. And so is depreciation, and amortization was 4.89%. We do not have a benchmark here, but it would be useless to have one. Depends on where your shop's located, if you own your own building or not. Visa and MasterCard discounts, that's painful to see, but how much money that you spent just on Visa, MasterCard, it might be other things like Diners Club or whatever other types of credit cards you accept. Bank charges and interest, for whatever reason, he's not putting them in there. I don't know why. Maybe he put them into line 109. And again, if you don't have each of these broken down the way they are, add it to the miscellaneous category initially. You don't want to think, oh, I don't have that information, so I can't complete this. Complete it to the best of your ability. See as much data as you possibly can. Interest on long-term loans, he doesn't have any of that. Cash over and short might happen from month to month. Bad debts, okay, I'm not sure what happened in one of those months, but again, we're not looking at trending right now. Vendor interest and discounts, if you're late paying your parts bill and you have to pay a discount, interest on that, or maybe you did 2% 10 net 30, and so that's going to show here as a discount, and of course, as a discount, it's going to show as a negative number because you actually got that as a credit, not interest that you paid. Line 121 is the total financial expenses, so we could see how much money that came in the door went just to that category, and it calculates for us again the percentage. Administrative expenses, I love the way this is broken down. Owner salary, so we can see that he's paying himself $5,100 a month, but he also has a manager. In this particular case, to the best of my knowledge, that's his son that works for him, and so he's seeing his salary as an owner and a manager. You think, oh, his son's making almost as much as he is, and some months he's actually making more. And I'd like to ask this question, because I ask it in groups in training, is how many times have you written a paycheck to an employee that you wish was yours? However, it's not a partnership in this case. His son does work for him, and so the profit of the business is going to dad, not the son. And maybe one day the son will take over, I don't know. But at this point, his salary is $5,100 consistently across the board. A couple months he paid himself a bit more, but again, we'll do that when we get into trending. And then bookkeeping and accounting. So he's obviously paying for that once a year. And by the way, if it's $1,325 that you can see that he paid in March, that really should be amortized and spread that out by 12 for the purpose of this. So you're seeing accurate data from month to month, but also again for the variance. Service advisor, in this particular case, the service advisor is his son who's the manager, and so there's no expense listed there. You could put it under his management salary if you want, or if the person's truly a service advisor. If you are the advisor for the shop, then you need to determine what you would pay yourself to be an advisor if it was somebody else you're hiring, or you went to work for somebody else. So maybe you're not a tech, you don't work in the bays. Well, then you need to allocate an amount for yourself as a service advisor so you can see proper information here. If you're an advisor and a technician, then you want to divide that out as well so you can see the true cost. If you went to sell the business and I went to buy your business and it showed zero for an advisor, I'd say, why? And you say, well, I did it myself. Well, what would I have to pay an advisor to do that? So your net profit looks good. It's 20%, but there's no advisor salary there. There's no manager salary there, or you didn't put yourself in as a technician. So I could buy your business, but I'm going to have to hire a tech because I'm not one. I'm going to hire an advisor because I'm not one. And there's no way I'm going to hit 20% because you didn't show any amounts for that. So make sure you do that properly. Office admin staff, not everybody has that, but if you do. Shop support staff, maybe you have somebody that's cleaning up the bays or whatever. If that's the case, we provided a category for that. Wage burden expense, and again, as I mentioned with burden, that's something you have no choice. That's EI, CPP, workers' comp, holiday pay in Canada. In the United States, SUTA and FUTA. The tax you pay is not an expense to you. It's withheld from their own paycheck. So we're only looking at additional costs. And we all know that if we're paying somebody $25 an hour, they're costing us more than $25 an hour because of the burdens that go along with that. Employee benefits. By the way, just while we're saying this, when I teach HR or employee management, or sometimes I call it daycare management, I like to be able to see a statement that goes to the employee. Once a year is a good way to do it, and you show them exactly what they cost you. So what you had to pay in the burdens and what you also paid in benefits. So if a person made $55,000, they would see at the end of that what their actual benefits were. Some people even factor in how much they saved themselves as an employee on parts because we sold them parts at cost or parts plus 10 or whatever it is. Some people add, the cleaning of the uniforms to that, whatever you want to do. But at the end of the year, I think it's important that we show our employees not just their gross wages, but the additional amounts that they received that we paid for them. Office expense, that could be any type of office expense that you're relating to. It could be software, it could be office supplies, etc. Anything you want to put under your office expense. It's a small percentage of sales, so it's not that important to get into too much of a breakdown for that. Computer lease, in the day that was important, and when I ran this with a company in the US, I won't mention the name of it, but they want a computer lease on there. What I like to see here is, because it's under office and admin, is maybe the lease that you're paying for your shop management system. So if you're paying a monthly fee for your shop management system, and again, because you own this Composite, you can simply go into there, and again, I'm typing slowly because I'm doing it on the other side of a microphone, and you can put simply shop management. Reach behind my I need to keep my microphone close so you can hear me well. Shop management system. So you could put that there, and so that would be whatever you pay for your shop management system. Phones and internet, pretty straightforward. And by the way, you want to make sure that if you're paying for Yellow Pages as part of that phone, then you separate that out, because your Yellow Pages is not a phone expense, it's a marketing expense, and it goes down later on. You'll see that under marketing. Any licenses and fees that you have to pay. Legal expenses, hopefully that doesn't come up too often, maybe once in a while. Training, any amounts that you spend in training. Meals at entertainment, the guy's not exactly spending well, some months look higher. And travel, and by the way, this particular fellow was in a management group, and so the travel expenses and the meals and entertainment sometimes were to go off to a meeting with us. Total admin, the dollars was 14,000 and the percentage was 14.53. We don't have a benchmark for those, of course, we don't need one. Marketing and advertising, this is one of my favorite parts of this actual financial composite. It's very comprehensive, and you can see is I like to see how much money we spent in advertising to bring in new clients. So that could be Yellow Pages, newspaper, radio, flyers being sent out through the post office, any expense to get somebody to come to you that most likely has never been there before. But we also want to be able to do client database marketing. How much do we spend to get people back more often? We've got the database of email addresses, and maybe we used MailChimp, or we used Constant Contact, or we used MechanicNet, or we use Customer Link, or any of those services. They're all really good services. How much do we spend marketing to our database to get people to come back more often? Donations and charities, subscriptions, memberships that could be your AllData. It could be, sorry, no, this is, sorry, I apologize. Again, I had to look myself under the heading of marketing. Memberships and subscriptions in this particular case is going to be things like I just mentioned with MailChimp. That's a subscription that you pay the same every single month. It could be MechanicNet or DemandForce. That was the one I was trying to think of. The total marketing expenses for all of those combined was $3,690 at his shop, or 3.65%. My benchmark is actually 6%, so he's actually not spending much on advertising his business, and maybe he needs to spend more. Down here we see the total expenses, so we see the $35,636, or 35%. Our benchmark, as we mentioned in the first class, if our gross profit is 60%, our expenses would be, gross profit is, sales would be $1 for every dollar that comes in the door. For every dollar that comes in the door, I've got to suck back and reload back to the first class. For every dollar that comes in the door, 40 cents you go to pay for what you sold, leaving you with a 60% gross profit, which is what we just showed here. Your expense benchmark is 40%, so 40 cents of every dollar that comes in the door should go to the expenses of the business. Considering he's paying himself a little over $5,000 a month, and he's paying his son over a little about $5,000 a month, and he's still at 35% total expenses. He's doing pretty darn good with expenses. I know this guy, he's a very good expense manager. Actually, he is so cheap he squeaks. He's almost the kind of guy that picks up rice after weddings. Not quite that cheap, but kind of, sort of. Then it shows the net profit in dollars for the month, or 18.83%. He's doing pretty good. The benchmark is 20. We've covered that in previous training. So he's doing pretty close to that. And then the profit for that month was that same amount, 19,000. So as I mentioned, there's trending, and I could explain that through as we went, but I love to show it as a separate thing because entering the data in the month is great. And again, if you want to just see January, you can just see January. You can see just February, and you can see just February there. And of course, if you filled in the forecast, and you're eventually going to see the variance to that as well. And again, one last time, always make sure you enter it into actual, not into forecast. I've had people send me their data and it's completely blank, and I look at actual, and then I go into forecast, because it allows you to fill the information here, and it could look like, you know, you think you're entering the data for that month, but you're actually putting it into forecast. and I look at the data and it's blank, and you go to look at the data and it's blank, you think, what happened to all that data I put in? Well, please make sure you don't put it into forecasting unless it's actually forecasting. But back into the actual data, and here's where the trending is really important. So now, when you've been doing this for, in this case, almost a year, the shop is, I think we're into September, October, something like that. Some data he was able to put in for some other months and he couldn't complete them, and that's fine. Just come back, put in data that you have, and when you get more data to put in, add it to there. But I love to see the data as it, this was first quarter 2015, by the way, and it's a real shop, as I mentioned. This is new customers in the month. So we can see in January at 45, down a little bit there. He got up to 47 new customers that month, 50 new customers, 56. So I love to be able to see that trending so that you can see this data across the entire year for all of the information. Sorry, I just had to go back there. Quick ratio, I don't want to get into detail on that, but he's pretty much maintaining that. That's not something you have to look at on a monthly basis unless something significantly changed, like a new loan or a mortgage or something like that. Receivables, he's obviously very good at the receivables. Days open, that's pretty straightforward. Technicians on staff, most of this doesn't change from month to month unless you hired somebody or got rid of somebody. You can see the total paid hours. But here's where I love to see the KPI. So the number of repair orders per day at the shop, 9, 10, 8, 8. So he's pretty consistent here. Now, this again is California. Being California, they don't have a tire season where he's at, so he's not going to see the variances that you would with November and March or whenever you start taking those winter tires off and putting on the summers. The average dollars per repair order, he's doing pretty good here. Now, it bounces back from month to month a little bit, but you want to see your trending. Is that number getting higher? Is it getting lower? So where's that number heading to? And sorry, this is a working Excel spreadsheet, so if I make a mistake, I have to go back and fix that. Average dollars per repair order, you want to be able to see that trend, and if you start really low and then you start to see some changes that you make and you implement some certain things and you get better and better and better at it. Sold hours per repair order, as I mentioned, the shop does pretty good. This is information you definitely want to see on a monthly basis. And then the trending of this, 2.87, 2.66. I'd want to know what happened in March. Why did we get to 3.18? And the dollar difference between that is huge compared to, you know, the repair orders that we wrote. It's either making every car count or increasing car count. This month he actually got up almost to 3 hours per work order. So I'd want to analyze that a little bit further with my shop. And if this was a management group, I'd say in July, what did you do? What did you do differently to go, you know, from your low end of 2.6, it looks like, to 2.96. Of course, in March he did 3.18. So I'd want to know what happened. And that may not seem like lots of a difference between 2.66. Just take a look. He went from 2.66 to 3.18. There's so much you can analyze here. His sales went from 50,000 to 58,000. And so that makes a huge difference. And then, of course, you can compare that to car count and other things as well. There's so many factors here. But for the purpose of the composite, I just want to get back into the trending. Effective labor rate. He collected $80 compared to 89 here, 79 compared to 89, 83 compared to 89. And by the way, this shop is not in the San Francisco area. I'd like to make that clear. I did have shops in the San Francisco area. He was very much closer to the Nevada border. And so if he was in San Francisco, of course, these labor rates would be higher, but his rent would be higher and his cost of technicians would be higher, etc. Unbilled labor time, something he did askew here. He needs to go back in and find out why that didn't work properly, but each of the other months looks pretty good. Look at that in August, less than, you know, almost only 11% of the time, or sorry, not even 1 full percent. He did extremely well there. He did some really good numbers here too. He sold 112% of his time there, or 112% of the labor rate, which is awesome. Labor to parts ratio, an extremely important calculation. What percentage of the money came from labor versus parts? he made some mistake here in February. And again, when you're going through this and you see these red numbers like that, you want to look back and go, what did I do wrong? Because it really meant you made a mistake somewhere. Now, not always, but if you're oh no, I guess that makes sense, the 89%. But some of these error numbers are really, really incorrect, like this 1.14%. Yeah, those numbers are wrong. Then you want to go through and see what you did wrong. Because if this month is 109% and this month is $1.14, something really went wrong. So, and if you can't figure it out right away, that's fine. Just save the document, come back and figure it out a little later on. Again, equipment purchase is not that important. Labor sales, again, trending. So I just want to end this part with this, is that this is brilliant information to be able to see your shop and the trending. You make a change and it's getting better, and you make another change and it's getting better, and then things start to drop off and you say, what's happening with our average repair order? What's happening with our labor to parts ratio? And you can see maybe you're forming some different habits, or you dropped off and making some of the changes that you've been making, or something happened. But you want to be on your game. You want to know what is going on. And then you need to ask yourself, why? Why is this happening? It's because I'm spending more money on marketing. Maybe that's why I'm getting new customers per month, or I'm spending more time selling on the counter, or whatever it is. So again, the trending, I'm not going to go through 172 lines of trending. You see what it is. And maybe my absolute favorite thing about this composite is it's tracking your profit year to date. So very encouraging to look. In January, you made $19,000. By the end of February, the shop made $30,000. By the end of March, they were $53,000, $60,000. Sometimes we lose sight of the big picture. And obviously his data started to change here. He wasn't adding it all in. And actually it says quarter, first quarter, but there's obviously more quarters. He didn't change the title of that. That's fine. Don't get into the nitty-gritty of that kind of stuff. For the purpose of a group, it's important. For your own shop, it's not as critical because you know what you're looking at because you entered the data. But it's kind of nice to see that, hey, I'm making some decent money in this business, and sometimes you lose sight of that and you think this month wasn't very good, but oh, my profit year to date is looking pretty good. Okay, so that is the financial composite. And the last thing I want to show you, and that's for those of you that choose to get into a group. Some of you watching this maybe are already in a group. As I mentioned at the very onset of this 5-part series, is I've been doing this year 30 years. And I look back at some of the people who've done extremely well, and I see numbers, some people, and think, wow, you're doing really, really well. And one thing I've seen very clearly is the shops that perform extremely well. There's two things that are common. Two, one is they're on their numbers. They know this kind of stuff. And two, all of them are in a management group. Now, some of them may be not in a group and I don't see them because they're not in a group, but I can assure you that when you are on your game and you're on your numbers and you're seeing this kind of data and you're working together with other shops to get assistance, this is really helpful, where each of us can help each other, working together as a team. Together, everyone accomplishes more. And it's about working together. We're not competitors one to another. And our new group that we're launching, just to let you know, is a maximum of 8 shops. We are going to cap it at 8 shops for the purpose of our online meetings, etc., which is the next part of this webinar. I'm going to pause it here shortly, and then you can continue on after that, maybe take a break. And of course, the nice thing about recorded webinars, you can pause me at any time and rewind. But here's where we're comparing shops, and for the purpose of this, I changed it to shop 1 through 7. But of course, well, what I did is I have the person's name on top, because when I'm in a meeting, I'd rather call you Fred than, you know, Joe's Auto Repair or whatever shop you're running. Maybe that wasn't a good idea or example, but Fred from, you know, Elite Automotive. I didn't want to go Elite, because I want to refer to that person as a name. So I went through and changed the name of these people individually. But now we're looking at the shop we just looked at, yes, but we're also looking at how they compare to other shops. And you may think you're doing really, really well in an area, and then you join a group and you see somebody else and you think, oh, well, that's really doing really well. I had one fellow in a group, in fact, he sees shop number 7 here, and his numbers were way out of whack. Now, when the person joins the group, pretty obvious that the first few shops all joined at the same time. Shop 7 came a little later on. But take a look at this shop, $22,524 in receivables. And by the way, this shop is not in California, just to be clear. He's doing well in some areas. He's just doing the work and not collecting the money in some cases. And again, for these particular shops, this was a different period. This was August 2011. It shows posted rate $116 an hour, $102 an hour, $127.50, $105, $104. By the way, it's a little confusing for me because I did run groups in Denver, Northern California, Nevada, Seattle. I think we ran 2 in California. So this may be not the same shop that I just looked at from the same group, but this guy had the lowest labor rate. Effective labor, that percentage was completely wrong. Again, this is the way it was submitted to us, but we had to use it that way. So again, make sure when you're filling this in, if something looks really strange, like your effective labor rate is $41,000, then you made a big mistake somewhere along the line, and you can go back and fix it. Of course, you have a coach if you're in a group, and you have the ability to get some information from your coach or your composite partner. And again, the purpose of me showing you this is we showed you from the beginning of this to take your financial data and start to see some of the KPIs. And then we added more KPIs. And now we're looking at this, which I believe is all the KPIs that we need to see. And now we see our trending from month to month. But one step further after that is to show how do I compare to another shop. And because we look at percentages, it doesn't matter what your labor rate is per se. It doesn't matter how much you pay for rent. It doesn't matter if you're in California or Ontario or British Columbia or Atlanta. I've run groups all across the country. The ones I just mentioned were for one specific company, but I've run groups in other parts of Canada, all across Canada actually, and some other states as well. And it doesn't matter that your shop is smaller than the other shop in the group or bigger than the other shop in the group, because it all comes down to percentages. Yes, if you're in Northern California, if you're in the San Francisco area, your labor rate's going to be much higher. But like I said, your rent's going to be higher and how much you pay your technicians is higher. The benchmarks that I show you are identical whether I'm training in Canada or the US. It makes no difference what state, what province. I've trained in all 50 states and every province in Canada and some of the territories. And I tell you that it doesn't matter when it comes down to percentages. Dollar amounts, rent amounts, how much you pay an employee. I've seen some people paying an employee, which in another state is almost what the labor rate is for a customer. But when it comes down to the percentages, you pay less for a technician, you're going to have a lower labor rate. If your rent's higher, then your labor rate's going to have to be higher, but your expenses are going to be higher. So what's really important, I'm going to scroll down here. Right here, line 65, the last one I want to cover here is gross profit benchmark overall. We said was 60%. So even though the shops are operating in different areas, this one's 50, almost 54, 60, just under 50, 65, almost 66, extremely good, 52, the shop. Now 70, that might have been their best month. So we're looking at all the shops. By the way, to be clear here, well, this was August. So this was August for every one of these shops. So though they took their data from August and they sent it to us, so instead of looking at August, in September, October, November for your own shop, here is we're looking at everybody for all the same data, shop 1 through shop 7. This group had 7 shops. Actually, look at some of the names that I still have on there, which is fine. Further down, you don't know who Bill is. I do. And Shari in that last shop, which, by the way, I know this shop really well, and they have really turned that around. They've become actually star performers, and actually Shari is actually somebody who is now doing some coaching for other shops. With that, we're done the section on the 5th part of this, which is the comprehensive composite. And again, I know I've said this, but enter data as you get it, pause it, save it, I should say, and then you can come back and add the data later on. If you don't have every one of these lines in your income statement, or you have more, combine them together. If you don't do towing and you want to put something else in there, then just go in, and rename it for yourself. Now, in a group, we don't want people changing all the names because when we're comparing information one to another, it's all going to be the same, right? But for your purpose, for your own shop, if the categories don't match up, make them match up. Change them here. Change them on your income statement. But you want to be able to see, again, GPS. Where am I? Where should I be? And how do I get there? So you can pause here. We're going to take a break. I'm going to bring Kevin in, and we're going to talk about what the management group is all about. With that, thank you for the 5-part series. It's been great going through this journey with you and the coaching that we've provided. And with that, we're done for now, and stay tuned for information on the group. Thank you.